Welcome. Glad that you all could make it to today's webinar. It's funny, we always take this technology for granted. We have people literally from throughout the United States on this call, and for good reason. This is a great topic, a great time to learn about this topic because it really is a phenomenal opportunity. It's one that we have been training people on for probably 2-3 years now, but it's just got a huge injection of cash and it's recreating what was a tremendous opportunity from before. So welcome everybody. This is Kevin Shortell. I'm the Director of Curriculum for Noteschool. It's a pleasure to be on here with you. And of course, we also have the founder of Noteschool on here with us, Mr. Eddie Speed.
Hello everyone. Hello Kevin. We are very, very fired up about this topic today. Because Kevin, you did a pretty good little teaser and you told me there was $2 billion out there and I could get some of it.
Yeah, that's right.
All true too, right?
Oh, absolutely. And it's, it just makes sense. And when we start to lay this out for everybody today, and by the way, everybody, we will have time for Q&A at the end. We'll try to get to as many questions as we possibly can. So as we're going through this, make sure that you take some notes and we'll make sure at the end that we can open it up for Q&A. Hope to get to everybody, but we may not simply have the time to do that today. But we want to lay this out, this strategy out for you very, very clearly. And in fact, we're going to go even through a step-by-step process on this and make sure that we hit everything that we promised we would on this webinar from the emails that you had received before. But Eddie and I talked about this and we figured, you know what, if I'm here listening to a webinar, I want to know who I'm listening to. Are they experts in the field? Do they have the action behind the words? And to me, that's critically important. And I know for Eddie, that's critically important to you as well. So I thought that that's where we would start by showing you really a picture here of the entire Noteschool team. And by the way, Noteschool is a part of a trilogy of companies, Colonial Funding Group and Colonial Capital Management, but this is our educational branch, and Eddie has done a tremendous job of putting together a team that really can handle every single facet of this industry here. So we're not going to go and read through all the names and point out everybody to you there, but these are all the folks behind the scenes and some of them in front of the scenes that help people every day with these concepts here. But we do want to highlight a few folks, and Eddie, maybe you can lead us through some of the executive team and trainers here so that people have an understanding of both, not just you and I, but also the people that assist us every day.
Sure. Well, I think it would start out with me. I founded Noteschool about 15 years ago. I've been in the note space now for 34, 35 years, started around 1980. So been doing it a while, and I've found that there was really a need for training in the note space. For people to really act on the opportunity, they really had to kind of know some specifics and how to do it. So next up, one of the key things was bringing in some people with some serious operational experience. Bob Repass. I knew Bob Repass. He was an executive at Associates and then later was managing director at Bayview. I probably sold Bob Repass, no kidding, probably $30 million in notes when he was running those operations. And then he's director of operations for us, managing director of the company, and really drives a lot of the investment side and the trade side of the business. Next is Charles Mangan. I knew Charles all the way through the 1990s. He used to be with Associates, and then I worked with him in different capacities. But Charles has an incredible 30-year experience. I tell Kevin, I tell people that Charles probably has managed foreclosures on more than 100,000 houses, and that's not exaggeration. And so just incredible experience here. By the way, Bob Repass has managed about $2 billion in note portfolios for literally probably 20 years straight. Susan De La Garza just celebrated her 23rd year with me, and that lady knows more about closing a loan file than anybody can honestly say I've ever met in my entire life. Her knowledge base is incredible. And she is an executive with our company and helps oversee the operations side and is heavily involved in the our note acquisition and trading business. There's Mr. Kevin Shortell. So Kevin is in charge of curriculum for Noteschool. He does a great job, and you'll see some examples of that today. Kevin has a long history in the business and has done a lot of significant business himself in doing the business, and obviously is active in the business as well as helping Noteschool with its piece. There's our friend Joe Varnador, and a lot of you guys may see Joe at RIAs or different speaking engagements, and he has a long history in the business and is a great contribution. And then lastly, we've got Dwayne Gibbs, and Dwayne is helps a lot of the students and works with people as far as training and the type of thing they would do, and that's kind of the primary role that Dwayne does. He comes to us with like over a 25-year experience in what we would refer to as adult education. So he's worked with other companies. Been with us about 10 years, I believe, Kevin. So
that's correct.
Yeah.
Yeah. And so it goes without saying that, you know, you've really put together a team that is second to none. There's no other entity out there that can have the same firepower, if you will, that we have. So let's go ahead. I know everybody's anxious to get started and get into this topic here. So let's start here. Why is the Treasury Department giving $2 billion to certain states that are still suffering from the real estate and finance crash? And I think, first of all, that's an important thing to point out. There is still a lot of suffering from the real estate financing crash. I mean, a lot of people have already kind of put that behind them in their minds, at least. Certainly the press has. But it's pretty obvious if the Treasury Department has to bail out another $2 billion just for 17 states, by the way, there's still some major problems in real estate. And part of what we do in our business, in our investments, is we are able to help people stay in their homes because the government has realized that they can't solve the problem. They can throw money at it, that's pretty obvious, but they can't solve it. And the banks have realized they can't solve it. And that's why you don't see a lot of the REO sales and the foreclosures anymore from banks, because they've got to throw their hands up and going, we're not equipped to do this. We can't handle it. So it's coming down to problem solvers. It's coming down to entrepreneurs like you and I and everybody on this call that does have the ability, with some specialized training, obviously, and with some specialized techniques, we do have the skills to right this ship, if you will, and really help people stay in their homes. And if we can combine that skill set with the funds provided by the government, I think you have a pretty clear direction of where a lot of this can go. So the crash, really, just as a refresher for everybody, if there was one slide, Eddie, that we use, I think both you and I, when we're talking about this, if we just had to pick one single slide that identified what happened that created all of these non-performing loans, it would have to be this one. Would you agree?
Yeah, it's interesting. This is Amherst Securities just did this, and I've seen this. I've been at other speaking events, Kevin, and seen other speakers use the same slide. It's pretty simple, but it's pretty dadgum clear. In 2000, you could borrow about 3.3 times your annual income, and by 2006, kind of the height of the subprime, you could borrow 9.2 times your annual income. So somewhere, some people thought that you could be a little more aggressive.
Yeah, I would say if people figured out they could borrow 9 times, well, guess what they did, right?
Yeah.
They borrowed as much as they could, even if they couldn't afford it if the rates went up.
Yeah. So that's really what drove the production, the volume, the inventory of these non-performing notes. And the government never really admitted to, the government and the top 50 banks, they never really admitted to the amount of inventory that the industry believed existed, right? But at a height, Kevin, at one point, there were probably over 12 million defaulted notes, probably closer to 14 million. but once again, they were foreclosing and then they were adding new defaulted loans. So the inventory was going down, but it wasn't going straight down, right? It was volatile. It was moving along. And the short answer is this, Kevin. We think that of all the defaulted notes, we think the bank's probably foreclosed on about half of it. And about half of the defaulted notes since the subprime debacle weren't foreclosed on. So there was clearly a situation that grows to be the biggest opportunity I've ever seen. Biggest opportunity I've ever seen my whole life, and therein lies our opportunity. So specifically today, Noteschool teaches how to buy performing notes and non-performing notes. A lot of different segments, but Kevin, you and I today are going to talk about specifically non-performing notes, okay, today, and we're going to talk specifically about non-performing notes where when you buy that note, the government will write a check to the delinquent borrower, enabling them to bring their loan current.
That's correct. So we're going to have a very narrow focus on this particular topic here, which I think is great because we can drill down on this very, very significantly here today. And it does evolve around these government programs. The government programs were enacted in the mid-late 2000s. Because the enormity of the problem, which you just saw in the last graph, was huge. And there all of a sudden you had millions upon millions of people who were facing foreclosures. And the government wanted to come in and say, look, we've got to stop this. We've got to prevent all of these people from losing their homes. How are we going to do it? Well, in the broadest sense of terms is the government programs that they created, they all typically have good intent, right? That's what they want to do. They identify a problem and they want to help fix that problem. Well, we also all know that a lot of times with good intentions, there is unintended consequences. And certainly that is a part of this component that we're going to be talking about as well. And I would say the third issue with these government programs is unless they're advertised, unless they're the big government programs that are advertised that everybody knows about, the very people who need these programs, they simply don't know about them. They're just not advertised anywhere. They're not promoted anywhere. And therefore what happens is people who fall behind on their payments have a tendency to hunker down. In other words, they don't answer any kind of mail. They avoid things, and they almost get conditioned really to do that. And it puts a bad situation into a worse situation. So what we're doing is simply identifying and letting people know and educating people to these programs so it can help them stay in their homes. And for many people, this is going to be the last thing that they would ever be able to do to stay in their home. So it's very, very important that we're able to learn about this, but more importantly, get it in front of the very people who need this. So the program, how it works and who it helps, I've got just a simple diagram that we put together here to illustrate this. And then I thought what we would do, Eddie, is go right into a case study. So I pulled one of our many case studies and just broke it down into a couple of slides versus having multiple slides on it, just to hit the highlights of how this works. But let's kind of go through and show everybody how this works and who it helps. So on the who it helps, it's the people who have not made a mortgage payment, and in some cases, we're talking years. There are people who have literally been living in their home in limbo under the threat of foreclosure for 3, 4, even 5 years or more. They have built up so much in what we call an arrearage account, meaning back payments, that it's impossible for them to come up with all that money. We also have a lot of people who are in situations that owe a lot more on their home than the property is worth. So we can illustrate it like this. So this is just your everyday, and Eddie, we see these throughout the Midwest, the Southeast, just every single day in our business, where you have these homes, good neighborhoods, but the values.
Yeah, so this is fairly typical. This house is valued at $70,000. One point I'm going to make, Kevin, about hardest hit funds is it is a low income program. And I believe the statistics are somewhat like this, like over 80% of all the people that have gotten money from hardest hit funds made their annual household income was less than $50,000 a year.
That's
and
correct.
like almost none of them are like over 90,000 a year. So
very small
this
percent.
fits these types of properties because hardest hit funds specifically was designed for people in low income categories. So you're not going to see this on the multi-million-dollar houses because that's what not hardest hit funds program was not designed for them.
Right.
So these are going to be we call these houses, Kevin, low price band houses. I mean, in the typical industry definition is the valuation according to the realtor, the broker price opinion. We refer to that as a BPO. The realtor's opinion of value is typically the industry standard is about under $125,000.
Right. So in a scenario like that, which is very typical, mid-America, Southeast predominantly, you've got people who the value of their houses have gone down since the crash, as we saw in that chart. And a person might still owe when you start to include negative equity and arrearage. And again, arrearage just meaning all the back penalties and principal and interest and all those sorts of things that have accumulated since they stopped making their payment. This is a very typical, very realistic example of that, where somebody has a house that's worth $70,000. They're not making their mortgage payment because who knows, maybe it was a job loss, a divorce, an injury, whatever the scenario was, they still owe $105,000 on that house. So they essentially have $35,000 of negative equity and arrearage. And I think everybody knows, but just that we don't want to assume here, but if these folks in this house were to just all of a sudden they're working again and started making their payment, it doesn't stop foreclosure, right? Because they still have to catch up on that arrearage account. So the program the government came up with, Eddie already kind of gave you the name there, it's called the hardest hit funds. Okay, it's called the hardest hit funds. That's the name of this government program that the Treasury created all the way back in 2008, and now they're injecting another $2 billion into in just a few months here. And what that program is meant to do is to pay off that negative equity and arrearage and even make the mortgage payment for this homeowner for up to a certain period of time. Maybe it's 12 months, maybe it's 18 months. So the average payout from the Treasury to help these folks is about $35,000. Some states are higher, some states are a little lower than that, but it's about $35,000. And the typical time frame that they'll pay for the mortgage payments going forward on behalf of the delinquent borrower is 12 months. Now, who do those payments go to? Well, those payments go to the note holder. So what we're saying here is if you came in and bought the non-performing note on this property, and Eddie, what might you pay for the non-performing note, typical home value, BPO value of $70,000 in today's market?
You would probably buy this non-performing note between 40 and 50% of the value of the real estate. So this note would probably cost $30,000 to $35,000.
Okay, so if you're buying this note, let's take the high number. Obviously, they're $35,000. If that's what you're paying for this note, first of all, your note is backed by a property that's worth $70,000. So you got a pretty darn safe investment just on that, right? I mean, you're in this thing for $35,000. Worst case scenario is you get the property back, which isn't a bad worst case scenario. Obviously, it's worth $70,000. But here's the deal: if the people are still living in the home, this home shows what we like to call, it's a phrase that you came up with, Eddie, which I really love because it's very descriptive, is emotional equity. These folks, even though they haven't made payments, they're taking care of it. They want to stay there. It's just nobody's working with them, right? The bank doesn't have the people, nor do they really care, because this is just one loan in a portfolio of billions of dollars. They don't take the time to work with the people. We can come in, buy that non-performing note. Let's say you did that for $35,000. You have these people do the simple application online or on phone, and we're going to show you that, by the way. You get them to fill out the application. It takes 90 days approximately to get approved. And then guess what? The government is going to send you, the note holder, $35,000. So now you have nothing in this deal, and they're probably going to make the next 12 mortgage payments on these people's behalf to help them get their feet back on the ground. That's how the program works.
There's some important things, Kevin. Nobody knows about hardest hit funds. I mean, of the general public. Kevin, right. I've done speaking engagements where I've had audiences of 500 to 1,000 people, where they were in hardest hit fund states. Hardest hit funds doesn't fit every state, right?
Right.
And they were in hardest hit fund states. There were a room full of real estate investors. 90% of them in the room would consider themselves knowledgeable real estate investors. So they know where they may not have all the same equal resume of houses they bought, but they are all pretty savvy about the general idea of buying opportunities, right? And I say, how many of you know about hardest hit funds? No kidding. In a room of 500 people and see five, 6 people raise their hand. I've seen it over and over and over. Nobody knows about it. Now, if you think a real estate investor doesn't know about hardest hit funds, do you think some working class borrower who's delinquent on their mortgage knows about it? They don't. It's crazy, but it's like there's all these billions of dollars that are available to a delinquent borrower to bring his mortgage current. They don't know about it. Real estate investors don't know about it. It is like the biggest secret I've ever seen. And you and I don't understand it, Kevin, but it's a fact.
You bet, because the program, once again, has been around since 2008. But what's happened now is that a lot of those states have allocated all of the money that they were given. And that's why this is such a timely and important topic, is because it was just announced a month ago that they being the Treasury Department is now going to kick in another $2 billion. And again, this $2 billion has a very important purpose and a distinct purpose, which is, number one, to help pay off that arrearage account and other debt. Okay, because sometimes they'll pay off other debt that's on the property, and I'll show you an example of that in case study in just a minute. And also then, number two, simply make the mortgage payments on behalf of a borrower for a certain amount of time. And by the way, I said about 12 months. But there's one state that will pay for 5 years. I mean, when I say on average 12 months, I mean, there are some states that do considerably more. So it's a very beneficial program for the people to enable them to stay in their home, get their feet back on the ground. But it's also a great program for us because we're paid very well, incentivized very well to help these people and stay in their homes through the process. So you want to do a case study here, Eddie?
Yeah, let's roll through a case study real quick. And by the way, there's a lot of questions coming in, and we just to sort of stay focused on the topic for a moment. We're gonna do our best to cover some questions at the end of the webinar, and we'll do this little case study real quick first. There's so many questions, Kevin. I don't know that we'll get to every one of them. They're all great questions. I'm not saying that. There's just a lot, but we're gonna kind of go through the questions first. So don't hesitate to type in your question, but we're gonna answer them and address those on the back side. So Kevin, tell us about some specifics here that we're looking at.
Okay, this is a specific deal that one of the folks that we trained on this program took and ran with it. Here's this whole picture of this property. So it's a little property, brick house. You can see it's happened to be in Memphis, Tennessee. And the property was purchased back in the peak of the real estate. I believe it was 2007 in this case. They purchased this home, believe it or not, for $70,000, Eddie. So they bought it for $70,000. Obviously, the property values in that area took a dramatic hit. In fact, this property was valued at $22,900. Now, they still had a loan on this property from when they purchased it, of course, and the unpaid principal balance, the remaining principal balance on it was $62,900. So, I mean, they're way upside down, right? Underwater, upside down, whatever you call it, in your part of the country. But they owe a lot more on this house, obviously, than the house is currently worth. And by the way, that disincentivizes people to try to make payments and that sort of thing. But this individual who lived in the home lost her job, and that's what caused her to get delinquent. And she got so delinquent over the period of time of a year that she just, with being so much upside down, was just disincentivized, unmotivated, let's say, to make those payments, and the arrearage accounts and all those sorts of things started to build up. In addition, by the way, which is also important, you can see up here, there was $3,000 owed in property taxes. Now, I bet there's many people on this webinar that are familiar with the fact that property taxes jump to the front of the line. So that's a problem that's going to have to be cured. Otherwise, this property could go to a tax foreclosure sale. And then, of course, the property was uninsured. Insurance on that property is about $785 per year. So this was the scenario, this was the problem that our student identified in doing due diligence, which is not a part of this call, but going through a whole due diligence process. And obviously we can lay that out, and maybe we can do that on another webinar. But they go through a due diligence process on this because, by the way, the person who bought this note doesn't live in Memphis, Tennessee. They live in Virginia. But with today's world, today's technology, we go where the deals are today. You want to really open up opportunity, go where this is. And of course, he focused specifically on these states that have these hardest hit funds. So that's the scenario that he is facing. And some of you might be looking at this and going, well, what would you pay for this? How would that work? Why would you even be interested in a property that's so much upside down, behind in taxes, insurance, and everything else? I think what you'll see is, as Eddie, you always say, is the price will close the distance between you and the asset here. So,
well, yeah, and there's a couple of things. I mean, like when we Noteschool tends to attract people that have a real estate investing background. That's not always the case, but it's fairly common. And what we find is this: real estate investors think in terms of investing in their local market. Okay, they're going to buy a local fix and flip property or own local property. And so one of the key things that we place a very high value in is that we show people how to buy assets across the country. I mean, we buy assets every day across the country. We go buy the opportunity in the market, and we hire local vendors that are local boots on the ground that do what need to be done, and we can live wherever we want to live. And so this particular student that bought this asset, I know, does not live in Memphis, Tennessee. I know this student, and you do too, Kevin. And they did not live in Memphis, Tennessee, and they never went to Memphis, Tennessee and dealt with it. But we showed them how to go do it another way. So it's hard to wrap your mind around that if you haven't experienced it yet. And so we're sort of, today we're just kind of dropping you into a case study of something that really happened, and here's the numbers. There's a lot of you in your questions that you're asking us on the board are great questions. Where do I find these notes? What do I do? Here's where it looks. Can I get a list of the states? All those are great questions, but we're just kind of we're sort of fast forwarded you to a guy that understood that Tennessee was one of the hardest hit fund states, and that he didn't live in Tennessee, but he could hire the work he needed done so that he could make this investment, kind of act as an investor, and not have to go play contractor, so to speak, and go deal with this house personally as far as driving up there and dealing with it. Because really what he had is somebody living in the house that wanted to keep the house, right? He didn't need to go to the house.
Right. And by the way, I do have a list of those states coming up in this presentation, and I'm going to even show you how you can determine how much money the states have left. So that's all coming up here. So good questions. So let's just go through this again here. So what our student looked at was a property valued at basically, let's say $23,000, but they owed $63,000, plus they had these other problems up here that amount to about another $4,000. Now, here's the good part. Because this was a non-performing asset, a non-performing note, he bought that note at a discount. In fact, he paid $7,100 for that note. $7,100 for the note. Now, he tried to work with the person and contact them. He got an attorney involved to try to help him facilitate this process, because many times these people who are behind on payments, that she had been for a number of years, they're hesitant to work with people. They're very they try to avoid things, and it's one of the things that we simply overcome. And for him, that cost about another $900 to help contact this person and have an attorney send her a little letter just letting her know that yes, this program's available, yes, it's a government program, all those sorts of things. So he's cash out, if you will, $8,000 in total in this transaction. So what Keith did very smartly, of course, we advise him, say, learn as much as you can about this program. So we mentioned so far that this money comes from the Treasury Department, but what the Treasury does is allocate it to individual states. And then the states come up with their own program on how they're going to get the money out to the people and what kind of programs and what that's going to look like. So in Tennessee, for example, that state entity that's in charge of these funds for Tennessee is called Keep My Tennessee Home. So Keith contacted Keep My Tennessee Home. He learned about the program. He got all the free applications. He got all the free marketing materials. All of that's available right online, folks, and I'm going to show that to you later on in this webinar. So we got all the information he needed right there, the contact, who she had to call, what website she could use, if she had a computer. All of those things are available through these state-run entities. Well, she got approved within 90 days. Now, Keith knew ahead of time that she's a very, very good candidate for being approved because he knew the program. But in general, throughout the United States, these programs, if they've lost a job or at least had a 30% decrease in income, if they were divorced or injured, and as long as they're not hiding $50,000 in a bank account somewhere, they're qualified. Okay, and once again, as Eddie pointed out, in these lower income areas, in these lower property price values, that's typically what always the case is going to be. So here's what happened. Of that whole arrearage account that she had, Tennessee said, look, what we'll do, Keith, is we will pay you, the note holder, we'll pay you $25,600. That's what her full arrearage account, that's the most that Tennessee would pay, $25,600. Now, so far he's doing pretty good already, right? He's only out $800, or excuse me, $8,000, and he's getting $25,600 back wired directly from Keep My Tennessee Homes into his business account. But you know what? We still had those other problems. We still had the property taxes, and we still had the insurance. Well, Keep My Tennessee Home decided we'll pay the taxes. So they paid the $3,000, and they paid $785 to have property reinsured. So when you add all those numbers up, the 25,600 plus the 3,000 and the 785, that is cash in and debt paid in total for 29,385. And what I mean by that is, if Tennessee included $29,385 in this initial payout to Keith, he would have had to pay the insurance and the taxes anyhow. Okay, so that's all full benefit to him.
All right, so Kevin, let me just make sure I'm following the money here. So Keep My Tennessee Home, who is the hardest hit funds program for the state of Tennessee, wrote a check totaling $29,385. Okay, they wrote a check to the investor, okay, Keith Warrington, the guy that owned the note, or his company, right? For $25,600. They wrote a check to the taxing authority for $3,000. They wrote a check to the insurance company so that they would have proper insurance on the house for $785. Once again, the total check was $29,385 broken into those three buckets.
That's correct.
Okay, got it.
You got it. So, well, what happened next? So he's, whoops, that should be $8,000, $8,000 cash out. He's already got the cash back, plus those other benefits, the debt being paid on the property, but it's not finished because Keep My Tennessee Home decided that they were going to pay on behalf of the delinquent borrower who lives in that home the next 18 monthly mortgage payments of $595.91. Directly into Keith, wired the money into his account first of the month, every single month. That's another $10,726 in total monthly payments over those 18 months. You're looking at a net profit here of $32,011.
Wow.
I don't have a calculator right in front of me here, Eddie, but
you know what I like to say, Kevin? You know what I like to say? It's enough.
Yeah, I can't get a.
I keep a financial calculator fairly close to me, and I happen to have one here right in my hands, and it is about a tick over $10,000 additional money.
Mm-hmm. Yeah, it's a pretty good rate of return. And what's interesting about this as well, if you remember going back in those slides, the property was only worth $22,900. He's already netted out more than what the BPO on the property was.
Yeah, and he bought the note at a deep discount back of what the property was worth.
Yeah, and you know what? There's still more to this, because Tennessee didn't require that he modify the original loan at all. So he still owns a note with a $62,000 unpaid balance with 300 more payments of $595.91. Now, at that point in time, after he received his 18th payment, can he modify that loan? Could he adjust the payments? Could he work with her if $595 is not affordable? Of course.
He can be Santa Claus because he has no money in the deal.
Of course, of course.
And he will. He's a good dude, and he's working with a licensed servicer. So this isn't like, I mean, everything that he's doing is compliant with the law and compliant with the regulations. It's still up to his discretion as to what he can require. But once again, he made an incredible good investment because he bought a note, got all this money back from Hardest Hit Funds via Keep My Tennessee Home, which is their state program. And then, but here's the best part. Here's the best part. What does the lady living in the house get? She gets to stay. I mean, and guess what, Kevin? I'll bet you anything. She had never heard of this program. She didn't know it exists. She knew nothing about it until he facilitated knowing about it and bringing it to her attention, probably through the servicer, probably through some communication. We've also worked with people that are local boots on the ground. A lot of times nonprofit type groups will work with them. There's even some vendors that'll go do this and introduce the idea to the borrower. But what is amazing, Kevin, is the borrower never knew this existed. In fact, one of the questions on the question board is, somebody says, how come the big banks don't do it? Kevin, would you explain to me how come the big banks don't do this?
The reality is the big banks can do this. The banks
but they don't.
Absolutely do this, but they don't. Why? I think it really just comes down to this. Look, this note for them is a part of a billion-dollar portfolio of notes. They don't have the people, nor the time, nor the patience to try to reach out to all these folks. It's easier for them to take all of these non-performing notes, package them up, and just sell them in a huge multi-million-dollar, if not billion-dollar sale on the open market and be done with it. And that's really the reality of it. It's as simple as that. You don't have to make it more complicated than that at all. But they absolutely can do that. In fact, the homeowners can do that. But once again, this program is not one of these government programs that's advertised at all. There is no way for you really to find out unless you just start digging and digging. But who in the heck is going to be at home and go, gee, I wonder if there's money out there. What would they call it? Let me check Hardest Hit Fund, right? They're not going to do that. So it's been very, very underserved for the very people who need this. And that's why I think there's been this huge injection again of the $2 billion in the states here. So let me show you the states that are going to receive this money right now. So these are the states. And you can see the allocations that they have. Now, I want to point out here, all I'm showing you is the allocations for this initial release of the $2 billion. What the states, what the federal government's going to do of the $2 billion, they're going to initially allocate $1 billion, and then they're going to see how the states do, and then they'll go ahead and release the additional $1 billion based upon the performance of these states. And you know what's interesting about that, Eddie, is the performance is how quickly do they allocate this money.
That's funny. Yeah, they're motivated. In fact, and of course, just a quick little story here. So Hardest Hit Funds originally was about $8.5 billion, and it involved 18 states. Okay. Mm-hmm. It was called the Hardest Hit Funds program. It was part of the TARP program. Okay, it wasn't Dodd-Frank, it wasn't SAFE Act. It was part of the original, government relief program to the banks that was called TARP. And so this started, as Kevin said, in 2008, and there were 18 states that were identified as hardest hit fund states. And if you can see the map there, you can see, there were about 4 states on the western side of the United States, Oregon, California, Nevada, and Arizona. And then most of the states were kind of in the center part of the United States in the what we would call the Rust Belt in the Southeast. And so virtually all the Southeast was covered. And then, kind of the Rust Belt, Indiana, Illinois, Michigan, Kentucky, and that part of the country. So, and then way over there, Kevin, they had Washington, D.C. and Rhode Island.
Yep, and New Jersey. Yep.
And in Jersey, yeah. So they progressed forward. They got rid of some of the money, Kevin, but they didn't get rid of all the money. In fact, at this point, before they recapitalized it with another couple of $2 billion, they only got down to about, they still had about $5 billion. Is that correct? About $5 billion of it was not dispersed.
Yeah, the problem was that the states several states, I should say, did a very poor job on getting the word out about this program. Okay, that's just how it worked. I mean, okay, the federal government gives them the funds, and now they have the funds, but the states didn't advertise. In fact, where I'm from in Florida, they didn't even have on their website, they didn't even have a phone number for people to call for the longest time. And that's why Florida was given $1 billion. They only spent, in 5 years, they only spent half of that money.
Yeah.
Right? Now, here's what the catch was, and some of you might have, let's see if they don't see it down here on, this is just a snapshot of the website, and I'll show you how to get to this website in just a minute here. But these initial funds that were given to the states going back in the early mid 2008, 2007 is the crisis, and this program was enacted 2008. Or 2010, my bad. The original allocation said whatever money these states do not spend by December 2017 must go back to the Treasury. So there's a lot of these states that are under pressure to spend that money, and they're loosening up the qualifications. They're increasing. The last time I did the research, there were 6 states, Eddie, that increased the amount of money that they would pay on the arrearage account. And some by substantial, because they have to get that money out. Otherwise, it goes back to the federal government. And what state agency wants to be known as the one that gave $500 million back to the government when it could have been spent in their state on their citizens? So
Kevin, let me give a little, just a simple, maybe an oversimplified definition of what is a likely candidate for somebody with hardest hit funds. Okay, and each state has somewhat of its own regulations, so it's not the same across the board.
Correct.
And so some of you asked really good questions, like what if they're on disability, or what if they're in bankruptcy? And so we can't specifically say, because some states allow that, some states don't allow it. So I'm going to kind of generally say, Kevin, this is when I know I have a hardest hit funds borrower he needs to be in one of these states. Okay, I know that he needs to be in one of these states. So if he lives in Texas, he's not available for hardest hit funds. Now, I live in Texas, and I buy assets in hardest hit fund states. So I can live anywhere I want to live and buy these types of notes.
Right.
So I have to be in one of the states. I know that I know it's probably going to be on a lesser expensive property. It's probably not going to be on a $200,000 or $300,000 or $400,000 property, because this program was designed for low income borrowers, right? Their annual income under $100,000 household income. Secondly, they have to live in the property. Okay, so this isn't designed for people that have abandoned the property and moved away.
Right.
Those are people, when we buy those non-performing notes, the best solution there is to make contact with them and get them to do a deed in lieu of foreclosure. So that way the house goes away, they don't get They don't have to fool with it anymore. It's a chapter they've torn out of their life and they're ready to move on. This program says that they need to live in the house. So they have to be low income, under 100 grand. They have to be they have to be delinquent on their mortgage, okay? And they have to be underwater, okay? Now in some cases, there's money even available, even if they're current, but they owe more than the house is worth. And some states allow that, some states don't, okay? But they have to have a problem, let's just say, Kevin. They either have to owe more than it's worth or be delinquent, and they have to live in the house. And yeah, I'm probably oversimplifying it, Kevin, but when you can check yes in those blanks, then the odds get really high that there's a deal there.
Yeah, and you know what? Many states now, because once again, they're under pressure to spend this money. Many states that I've researched very recently, Eddie, they do have special programs for unemployed people. Yeah. So no question about it. So these programs are expanding and expanding. In fact, to learn more about this, you want to get to this website. Okay, now this is just a screenshot of the website, but I'm telling you right now, the easiest way to get to this website is just Google hardest hit fund, okay? Because the URL is it's one of those, it's about a mile long, you know? Yeah. So if you Google search hardest hit funds, the first one under the ad is the Treasury Department. And their website's gonna look exactly like this. And if you're interested in knowing what states are changing new programs and how much money each state currently has, every month these states have to report to Congress. So over here on the website, you'll see a link that says reports. And typically page 4, sometimes it's page 5 in these reports, it'll have a diagram there. And it shows you how much the states were allocated, how much they've spent, and how much they have remaining on there. So that's where you can get that information. And down here under resources, this is the state by state information. So you'll see addendums in there. When you go through the addendums, you'll see new programs they've added on. I mean, we're focusing specifically on this particular one, but there's cash for keys programs for deed and liens today. There's principal reduction funds. There's all kinds of funds available. We just simply don't have enough time to go through all of them on this particular webinar, but that's what they do. They put addendums on here for the state by state information, and you know what? That's what gives you the individual state websites. That's what gives you the fact sheets, the contact information. All of that information is there. And again, it's been there. It just nobody knows about it, number one, and a lot of people just simply don't know the process on how to get people involved in that. So you want to do a little step-by-step maybe, and then
let's do it. Let's do it. Yep. Let's roll it out.
Just as a little recap here for you. First of all, if I was on this webinar and hopefully we piqued your interest. If this doesn't interest you where you can tap into this, I'm not sure what could, but it's that big of a deal. So the first thing you have to do is learn about the program. And that's where you're going to want to go to that website, start to do a little bit of research, that sort of thing to figure out what works. And then if you really want to make the most money on this, obviously you're going to look into buying non-performing loans. And you want to focus on just those states. Remember, this is state specific. So if we go back to that map there, as Eddie indicated, all these states in white, they don't have hardest hit funds. You cannot do this technique in those states because they were not considered hardest hit by the Treasury Department. So buy a non-performing loan in those states, but as Eddie pointed out, very importantly, owner-occupied. You want to focus on owner-occupied properties where they have delinquent borrowers. In other words, non-performing loans on owner-occupied properties, and preferably ones that have that emotional equity that we talked about. Next, reach out to the delinquent borrower. Let them know about the program because they don't know. That's a big issue. The application is nothing. They can even do that over the phone today in most of these states. They'll have to probably gather some information and maybe some pay stubs or something like that, but it's not that difficult of a program to apply for. Stay in touch though with the state entity, make sure that the deal is progressing, and most of the people that we train, they just have their servicing company do that, so they outsource that. And approval takes It's 90 days. It's shortened. We used to say 90 to 120 days, but all of the folks that I know have done these deals more recently have been taking about 90 days. So I think they've, once again, they're incentivized to spend this money on a state level. Therefore, they're shortening the process with this. And then the funds are wired. So, we always like to say cut a check, but the reality is today they just wire the money right into your account. So if I had to break it down into 6 steps, that is pretty much how that would look.
Yeah. A couple of points here. These are not loans that you're necessarily going to be servicing yourself. You're going to have a licensed servicer that is servicing the loan, and there's ample servicers that will service just literally one loan. Now, we all know Bank of America and Chase and the big guys, right? They all outsource a lot of the servicing of their loans, right? They don't, because they own the loan doesn't mean that they physically are the ones that are the gatekeeper of taking in the payments and sending out the tax notice and all that type of stuff. So an investor is going to have a servicer. There are specialty vendors that will work with delinquent borrowers and hardest hit funds. Now, they do charge a fee. But obviously, you see in the case study we did, there's plenty. If you make this deal work, trust me, paying a fee to a vendor that's going to go kind of glue it together with the borrower is not really a problem, right? The amount of money they get and what you're paying for these notes is the case. So really, as Kevin said, it's just there's some target focuses that we do. That we did here today. This is a buying delinquent notes, and the opportunity that exists is the biggest opportunity. I've been doing this now for way over 30 years, and it's the biggest opportunity I've ever seen. The biggest inventory that exists I've ever seen. Basically, the agencies, Fannie Mae, Freddie Mac, FHA, just them, not Bank of America or Chase or Citi or any of those guys, but just the government quasi-agencies have over $100 billion in non-performing notes that are going to be sold over the next few years. So inventory, Kevin, let's just say is not a problem.
Not a problem at all. Yeah, go ahead.
And so with that being the case, it's a matter of doing the smart stuff and really just making sure that you kind of understand the rules. So what we did today, guys, is we picked a very, very specific target about buying non-performing notes. We picked hardest hit funds. We've been teaching hardest hit funds program. This is what we did for you today is a fairly good example of what we do in a class. And so you guys got about an hour session today of what would be an example of what we typically do in a class. So there's a lot of different topics. You guys have asked some great questions. Kevin, I'm going to kind of bust through them here pretty quickly, and some of them are maybe a deeper subject than we're able really to address in a sentence or two. But I'm going to kind of talk about some of these questions that people have posted. There's so many, I don't think I can get to them all. But I'm going to kind of throw this up here now, Kevin, to kind of give you a sense. I'm going to go back and renew a question that I mentioned a moment ago, Kevin, because I don't want to say it's funny, but it may be, the answer may be ridiculous, okay? The question is great. The answer to the question is kind of ridiculous that it's a fact, but it is a fact. The question is, why don't the big banks do this? What do you think? Why don't the big banks do this?
Yeah, that's, again, they just don't have the personnel. I remember probably 4 or 5 years ago, we used to talk in terms of, remember how the banks were on the big buildings, right? And then you had that small loss mitigation department. And then all of a sudden you had this huge loss mitigation department in the middle of all the foreclosures. And now what we've seen is it go back the other way, that the banks just don't have the personnel anymore. All those departments got trimmed down, way down, and they decided to shift their focus. They said, why are we trying to get in the real estate foreclosure business? Why are we trying to work with delinquent borrowers when we can just package this stuff up and sell it. And that's really the attitude that they took, and that's the approach that they took. And there was actually some, without going into further detail, but there was some government pressure for them to do that, by the way, as well.
Yeah, a lot of pressure for them just to get rid of the notes. And we were teaching this literally, Kevin, gosh, I want to say almost 4 years ago now. Mm-hmm. That we knew the banks were going to box up all these loans and sell them. They were a little slower in selling them than we thought. Maybe, we missed when we thought they were going to start really escalating, selling them by 6 months or something. But Kevin, how many delinquent notes were sold last year that were a big enough trade to hit the press?
Oh my gosh. Was it, I've just ran some other numbers for this year. Was it 8 billion? No, 11 billion last year.
No,
11 billion.
Yeah. Yeah. Well, the cumulative number, I think, was 18 billion, but I know what you're talking about. You're saying specifically, like if you're naming these specific trades of Fannie Mae, Freddie Mac, FHA, Bank of America, those type of things.
Right.
Just the trades that were big enough, which probably were a portfolio sale of 50 billion or more, right? Crazy numbers, or 50 million or more, rather, what I'm trying to say. Just crazy numbers. Now, we buy portfolios of loans all the time. We bid on probably 2 or 4 portfolios a week. And none of the trades that we buy are in the press. So you got to know that there's hundreds and hundreds or thousands of investors out there buying assets every day that aren't a big enough number for them to put it in the Wall Street Journal or DS News or wherever, right? So there, but I do know that I've worked with a lot of servicers and consultants for a lot of these agencies, and just Fannie, Freddie, and FHA has at least 100 billion that they're going to liquidate. Now that doesn't include the big banks or some of the securitizations that sold them. So it's like people ask me, well, they say, well, when we buy all these loans, and I kind of laugh and say, this is such a mountain for us to
chip
work off, to chip off of for the next few years. I'm going to say at least 5. This is such a big mountain. I can't even think about what we're going to be talking about next. I mean, this is such an inventory so far in excess of anything we've ever seen. We'll figure out what the next topic is, but let's go figure out. We got Mount Everest of non-performing notes to deal with at the moment, kind of, so to speak.
Right.
All right. So let me look at more questions here. Yeah. Somebody asked about seconds. Kevin, does this also apply to seconds?
In some states it does. So what I did myself for my own research, I went through those same websites those same reports that I told you guys about and where to find them on this website here. I went by the state by state information and just created a little spreadsheet for myself, and it will tell you in those details if they work with seconds or not. But yes, there are some states that do that. It's not the majority of the states. If I had to pick a number off the top of my head, I would say there's probably 6 or 7 out of those 18 states that do programs for seconds at the moment.
Yep. Okay, so just a couple of things. A couple of you asked questions about the charts and wanting to see it and stuff. And we've covered a pretty significant amount of information, Kevin, in about an hour, and we want to. So we had to make this fairly quick. But Kevin did say, if all you got to do is just Google hardest hit funds, and you can go pull these maps up and stuff. It'll be fairly easy to do. Let's see. Somebody's asking a question about self-directed retirement accounts. And Kevin, is self-directed retirement accounts a big deal in to Noteschool students?
My gosh, it's one of the biggest deals. I mean, you put us on a long time ago a directive of, we want to show people how to make an annual income in 6, 7, 8 months, and we want them to focus the rest of the time of building up those retirement accounts. So all of these things that you're looking at, and again, this is just one particular strategy and technique here, but all of the things that we do on the note business, absolutely you can do through your self-directed retirement accounts, and not just IRAs. I mean, there's 401ks, covered Ales, and a whole slew of other accounts that you can do these through. Imagine doing all this and paying no taxes. I mean, it's crazy.
Here's what I think, Kevin, is an amazing statistic. So we have the ability to buy in bulk. Sometimes we'll buy 100 at a time. Sometimes we'll buy 500 at a time or more, right? But we buy these types of loans, both paying and non-paying loans, in bulk. And then we have a distribution system. So the people that are involved in Noteschool have a chance to buy these assets on a one-off basis, okay? And depending on what level of training they do and all that type of stuff as to what that is. So I won't get too wrapped around the axle on all the details of that at the moment, but we have a lot of students that are actively buying notes, and we know they're buying notes because they're buying them from us.
Right.
And so that's pretty clear. And we tallied up at the end of the year last year, and last year over 35% of every note we sold was funded with self-directed retirement account money.
What was that again? What percentage?
Over 35%.
Yeah, that's great.
So somebody's question about self-directed retirement accounts is like, is that a big deal? It's a big deal. Yeah. And really that's where a lot of people are sitting on uninvested funds, what you'll hear me refer to as dry cash. And so this can be performing or non-performing notes, and we have students obviously buying both with it. So it's a big part of our business. All right, so let me go back to the questions here a minute, just to make sure I've kind of covered I think some of these things we've kind of covered in the as we've gone through it, if they're bankrupt, or if it's this or it's that or something, and you kind of gotten Kevin's answer on hardest hit funds overall, and that really is states have some unique things that they require. Each state is a little bit different. And
we do have a case study of where was that property? Alabama, I think, where the people did declare bankruptcy and hardest hit funds approved it.
Yeah.
We can't have
I know we have a case study. Yeah, that
was Paul. That was
Paul's deal. And it's a funny thing. That lady, her husband died. And this was a loan where she was paying, but she never just could get it totally straightened up. Right? She was good lady. She was making payments, so she was delinquent, but she wasn't like dark. She was making payments every month. She just couldn't get it current. Mm-hmm. And my friend Paul had that asset, and he's a real active student, and so I saw him a fair amount, and I said, Paul, I'm telling you, she went to hardest hit funds and they told her no, and I said, Paul, I know enough about hardest hit funds to know that they're just not giving her the right answer. I said, she needs to bang on their door a little bit. And this lady's really sweet lady. She's trying. Her husband had died. She had a daughter that was in college, and she's just doing all she could do. And she loved this house. As you heard me say, she had emotional equity. And they wrote a check for about $30,000 that covered all of her arrearage and let her pay down the balance on the mortgage that she owed to. And then once they paid it down, then Paul was able to adjust her payment. And now all of a sudden she's chipping off, and she's going to have this house, paid for in about 10 years. She went from owing more than it's worth and desperately trying to keep it, but just hanging on, to hardest hit funds coming in, and now all of a sudden she's now got a lower monthly payment, and now she's going to have a free and clear house in about 10 years. I don't know what you call a winner, but that's me.
Yeah, that's win-win-win everywhere across the board. And the other thing too that I hope everybody picked up on that is, again, initially I think when the program first came out, they wouldn't have approved her, I don't think, with the bankruptcy. But again, most of these states are behind on spending what they need to spend, and they're under pressure, and they are loosening these purse strings. And ultimately, it works out better, because think about it. Now this woman, as you just did that whole scenario, but I'm thinking it from a government standpoint, you have this property working again. In other words, yes, it's showing good value. It's got good taxable value. She's paying the property taxes now, and that starts to fill coffers of the local government. So there is a reason, why the government is incentivizing all of this. But you're right. In unique cases like that, you've got to push. And Paul was able to help her push that through, and under your advice. And obviously, as you said, it's win-win-win.
All right, so just to kind of wrap it up here, Kevin, we've mentioned several things specifically today, what we did is, if you think in terms of it, there's a great big pie of notes out there, and pie of different types of notes you can buy, and different specialty segments you can do. And Kevin, you and I just took a little slice of pie of a big story, right? And we did a drill down on it, which is hardest hit funds. There's all kind of really cool stuff that you can do with these notes. Now it's gonna, once again, you know, like people say, well, where do I find the notes and what do I look like? Well, that's a deeper topic, and those are things that we'll continue to address. You know, we'll have more webinars and we'll address them, and always, you know, we like, you know, people doing training stuff, because, you know, we just, what we gave you today was kind of an example of about an hour's worth of a class, but once again, it's now all of a sudden your field of vision and what the opportunity is, and we're not laughing because it's funny. We're laughing because it's ironic that this government program totaling over $10 billion is such a secret. But it is. Why? I don't know. I don't know. I don't think I think Kevin's right. I think the government had good intentions. I think the big banks had good intentions. I don't think anybody had any malintent. If you were the bank and you had a delinquent mortgage, why wouldn't you want your customer to get the money and get their loan called current? Sure, you would. But it didn't. But there were some inefficiencies. And as you said, Kevin, they've softened up on some of their requirements. I think when they started, the states were administering these hardest hit fund programs, and I think they thought that there was so many delinquent mortgages that they would just set a regiment and everybody just fall in line. And I think then they woke up and found out the customers didn't know about it, and maybe sometimes their criteria was too tight. And so, you know, like everything else, they had to, as life proved out what was going to happen, then all of a sudden they had to make adjustments. And so now we're kind of reporting to you today a phenomenal story, because hardest hit funds program has been slow to start and slow to success, but now it's a screaming success. And it's a screaming success for people that are note investors that understand that their borrowers can get a check essentially to cover the back payments that they owe, and even payments going forward. And as you said, Kevin, based on the price we're paying for these notes, in a lot of cases, it covers the cost you paid for the note, and the rest of the note that you end up modifying, you have no investment dollars in. And you saw Keith's scenario today. He cashed a huge check up front. What was it? Almost $20,000?
25, yeah, 25,000.
And from what he paid for the note, and now he's still got a note. And so once again, when the government stops making her payments in 18 months, then obviously he'll probably modify the note and cut the amount she owes to where she can get it paid off. Pretty fun story, huh?
That's good stuff.
Guys, we really appreciate your activity. Kevin, we maxed out. We had so many participants that if you didn't get on the webinar early today, you got shut out. We had about 270 people. No, now it's 330 people that did not get on the webinar.
Oh, wow.
So we appreciate your attentiveness. We know you were here early. We had a little technical difficulty. We started a couple of minutes late, but we appreciate your patience with us, and you stayed with us to the very end. And we appreciate the fact that you saw the entrepreneurial opportunity to not just make an incredible investment and get a return on your investment, but you also saw the opportunity to help somebody else utilizing this government program that the government wants you to utilize. They want you to utilize it because it's not been utilized as well as it should have been. So as Kevin said, it's a win-win-win. And we thought it was a great topic, and we'll continue to have some of these informational webinars and just tell you a little sliver about opportunities we're seeing out there in the market, one little piece at a time. Kevin, wrap us up, brother.
All right. Well, I think you pretty much summed it up in detail there. It was a pleasure speaking with everybody, and hope you learned quite a bit from this. And this is going to be definitely an area that we pursue individually, but also we're going to help a lot of other people learn this so we can help solve this big problem. And it still is a big problem in real estate today, but this is one solution that we can apply. Many others, but this is one I think that's going to have a very impact starting very, very soon. So thank you all for being on, and truly hope you enjoyed it. Eddie, it's always a pleasure, and we will talk to you again sometime in the future.
Sounds great. Thanks.